Retirement accounts are terrific ways to save for retirement. Still, they're only available when you have earned income, like a salary or hourly wages or access to a workplace retirement plan, like a 401k. However, there is an important exception known as a spousal IRA or individual retirement account. This podcast will review the benefits of a spousal IRA, who qualifies for one, and how to use it to boost your retirement nest egg. Welcome back. I appreciate you joining me for Money Girl episode 896. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, founder of the Money Stack, that's my Substack newsletter, and host of Money Girl with over 43 million downloads. If you're enjoying our free content, take a moment to rate and review the show. And if you have a question about money, please leave it on our voicemail at 302-364-0308. You can also visit lauradadams.com to email me directly and learn more about my books, courses, and the free Money Stack newsletter. All right, so let's talk about what exactly is a spousal IRA. It's not a different type of IRA, but just a rule. It's a rule that allows a married breadwinner to fully fund their spouse's IRA, even if the spouse has little or no income. So you can kind of think about it like a workaround that enables a working spouse to contribute to an IRA on behalf of their spouse. But the rule only applies when you're married and file taxes jointly. So I want to make sure you understand that if you're married but you're filing taxes separately, you do not qualify for a spousal IRA. Also note that an IRA can never be owned jointly, even when you're married. They're always owned individually. That's why it's called an individual retirement account. So a spousal IRA is still in the name of a non-qualifying spouse, but it's just funded using household earned income. So to understand the benefits of a spousal IRA, let's kind of step back and review the general benefits of IRAs and who qualifies for them. With a traditional IRA, contributions are made on a pre-tax basis. So that means they reduce your taxable income in the year you make them. You only pay income tax on contributions or investment earnings once you take withdrawals at some point in the future, typically in retirement. And the IRS requires you to take taxable distributions or required minimum distributions, RMDs, starting at age 73. Now, with a Roth IRA, you get different tax benefits. Your contributions to a Roth account are always made on an after-tax basis. So you don't get an upfront tax deduction, but you pay no additional income tax on the account when you withdraw in retirement. So those contributions and earnings are growing tax-deferred and get to be taken out entirely tax-free in retirement if you've owned the account for at least 5 years. And there are no required minimum distributions from Roth accounts, another nice benefit. You can make IRA contributions regardless of your age, so as long as you've got earned income, you can be a minor or a senior. However, you generally must have taxable compensation, a salary, wages, commissions, tips, bonuses, or net income from self-employment. Other types of income like alimony or investment earnings and payments from a pension or annuity don't count as compensation when we're talking about qualifying for an IRA. All right, so let's talk about how much you can put in. For 2025, you can contribute an amount to a traditional or a Roth IRA that's equal to your qualified compensation up to a maximum of $7,000 or $8,000 if you're over age 50. However, there is an income limit to qualify for a Roth IRA that I'll review in a moment. For example, let's say you're a student or maybe even a senior who works part-time, and let's say you earn $5,000. You could contribute up to $5,000 to an IRA. But if you're 40 and you earn $100,000, you can contribute at most $7,000. Withdrawals of any untaxed funds from a retirement account before age 59 and a half would be subject to income tax plus an additional 10% early withdrawal penalty. Therefore, you shouldn't put money in a retirement account that you might need to spend. In general, it's best to avoid tapping a retirement account early so that it can reach its full growth potential. All right, so now let's talk about the Roth IRA income limits that I mentioned. The Roth IRA is unique because it's the only retirement account with an annual income limit. For 2025, single taxpayers with modified adjusted gross income, or MAGI, below $150,000 qualify to make a full contribution. They can max out the account. And if you're married and file joint taxes, your household MAGI can't exceed $236,000. If you're under that amount, both of you can fully fund a Roth IRA. Another important rule is that when your spouse participates in a workplace retirement plan, like a 401k or 403b, your ability to deduct traditional IRA contributions may be reduced or eliminated based on their income. But there is no conflict with maxing out a workplace retirement plan and a Roth IRA in the same year. So let's talk about how a spousal IRA actually works. I'm going to go through an example of how a married couple might benefit from a spousal IRA. Let's say we have John and Lisa. They're under 50 and they decide to start a family. If they file a joint tax return and one wants to be a stay-at-home parent, they can each fully fund a traditional or a Roth IRA if their income isn't too high. So they could put $7,000 in John's IRA and $7,000 in Lisa's IRA. The spousal IRA contribution can go to an existing or a new IRA. And I'll talk more about that. However, if one spouse in the couple were over 50, the couple could put in a total of $15,000. It would be $7,000 to one of them and $8,000 to the other's IRA. Or if both are over 50, they could contribute up to $16,000, putting $8,000 in each of their accounts. Now, I received a great question from Barbara, who said, "My husband and I each contribute to Roth IRAs. However, in 2025, I won't earn enough to contribute the maximum. Can my husband set up a spousal IRA for me to make up the difference?" Yes, Barbara, this is a great question. If you're married and file taxes jointly, each spouse can fully fund an IRA using this spousal IRA strategy. Of course, your household income must be under the annual income limit to qualify for Roth IRAs. So don't miss the opportunity to max out an IRA if you're married and you're not working, or you're like Barbara and you're just earning less than the annual contribution limit for your age. All right, let's talk about how to open a spousal IRA. Regularly investing in a tax-advantaged retirement account for long-term growth, I think, gives you the best opportunity to reach your retirement goals. And while the limits on IRAs, aren't as high as some workplace plans, you just want to think about it as one component of your retirement investing strategy. For IRAs, you have until your tax filing deadline to make contributions for the previous year. So if you want to max out an IRA for 2024, you have until April 15, 2025. And as I mentioned, if you already have an IRA, you can use it for spousal IRA contributions. Or you can open a new IRA with any financial institution or investing firm and use that for your spousal IRA. But we'll go through 4 steps for opening an IRA. One is simply to choose a brokerage firm. You might choose the same bank or financial provider that you already use for other investments. You can just sort of think about centralizing your accounts with one firm. Or you can choose a completely new financial institution. The choice is yours. And you can have as many IRAs open in your name as you like. So, just be sure to compare an investing firm's fees and investments when you're making your decision. All right, the second step is to submit the required documentation. You have to share some personal identifying information, such as your social security number and address. It's kind of like opening any other type of financial account. Number 3 is to fund your IRA. Once you open a new IRA, you can connect it to an existing bank account and set up a one-time transfer or recurring deposits. Just be sure your contributions won't exceed the annual limits if you do set up recurring deposits. And 4 is to choose your investments. Funds that you contribute to an IRA can't grow inside that IRA unless you allocate them to one or more investments. I always recommend selecting funds based on your risk tolerance and goals, like a highly diversified and low-cost index fund or exchange-traded fund or ETF. The investing firm you choose can definitely help you pick your investments. They may even have some automated way to indicate your risk tolerance where they will set up a portfolio for you. It's really easy. If you've never opened an IRA before, I think you'll find it really straightforward. Barbara, thanks for your question, and I hope this will help you and everybody listening take advantage of a spousal IRA to boost your retirement nest egg. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have a terrific team that I want to thank. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.